Welcome to the Underserved Market webinar with CFSI, Core Innovation Capital, and Morgan Stanley. We thank you all for coming today, and we hope that this is a fruitful hour to investigate the new developments in the financially underserved market in 2013 and projections for 2014. Today we have with us myself, Eva Walkowitz, an analyst in the Insights Analytics team at Center for Financial Services Innovation, known as CFSI. We have with us also Ariane Schutte, who is the managing partner at Core Innovation Capital and a co-author of this report. And we have with us Moses Choi, Vice President of Global Sustainable Finance at Morgan Stanley, our generous sponsor and advisor on this report done annually. This report is one in an ongoing partnership of reports and studies between CFSI, Core, and Morgan Stanley that have been conducted over the last 3 years, including the past 2 annual market size reports in 2011 and 2012, as well as a report on financial technology trends in the underserved market and on investment activity in the underserved market as well. This has been a fruitful partnership between our 3 organizations where we can all contribute our expertise to exploring this market and its opportunities both for providers, investors, and consumers. Since we began this work investigating the underserved market, we can see that it's grown quite a bit. The first year for which we have full information is 2009, and since that time, we've seen the market grow in the aggregate from $81 billion to $103 billion, and projected to grow up to $107 billion in the 2014 year we are just completing now. This represents 26% growth between 2009 and 2013, and that represents a compound annual growth rate of about 6% per year, showing the substantial growth in this market and the momentum it has. And we continue to see that year on year, which is very exciting. This year, today, we are looking at the 2013 market size report, which is our 4th annual study that works to establish both the size of the market for financial products and services utilized by underserved consumers and also the growth in that market. We're looking at the fees and interest revenue that consumers spend to borrow, spend their money in transactions, save, and to plan on a variety of products, as well as the volume of use that they generate by buying and using those products and services, and the growth rates of the products and product categories in this market. And we'll also look at some interesting trends and developments that help tell the story of why this market is growing and what we should be looking at in the future. To those of you who've just joined, I want to also indicate that the last portion of the hour will be a Q&A session, and we encourage you to send in questions at any time by typing in the question box on your GoToWebinar control panel. All right, well, let's dive into the underserved market. First question that's useful to ask, I think, is what is the underserved market? Who are the people, who are the consumers that define this market? And they're defined by a combination of factors, really. One is the idea that many people in this market use alternative financial services, what the market would call underbanked in the general terminology used by the FDIC, and estimated about 68 million people. That's about 28% of U.S. adults. We also take into consideration U.S. consumers who have subprime credit scores or thin or no credit files, and those who may find their access to financial products otherwise limited by low to moderate income or income volatility that challenge them. And together, these factors make up the underserved market, as well as those who are underbanked within that. Another factor to consider is financial health, which is a vital goal for all American consumers and a vast market opportunity to support the financial health of Americans, particularly those who are underserved. And this, again, is even a wider market of people who may use alternative financial services or have subprime credit scores, thin or no files, or be otherwise challenged, and those beyond those categories who are still seeking financial health and looking for the opportunity to find financial products that meet their needs. And we define financial health as the idea that an individual's daily financial system functions well and increases the likelihood of their long-term financial resilience and opportunity. That means we're talking about products that support their day-to-day financial management, resilience in the face of financial ups and downs, and ability to pursue long-term financial opportunity and success. So that's a little bit about who is in our market. And when we look at who is in this market, we of course then look at what products they're using to meet these needs. And as such, this is a current scan of the underserved market landscape. It's everything people use that we think is relevant among 26 products. It's not a statement, however, on the safety of these products or appropriateness or quality for consumers. These products vary a lot, both between products and in a certain product category. There's certainly a lot of business models and variation. So it's important to know this is a snapshot and not a recommendation in any way of these products themselves. And at the same time, we should also be aware that there are many revenue models and fee structures, again, within products and between products we look at. So that can lead to variations in quality, and it also means that we use a variety of methodologies to best capture market activity depending on the product. The study that will be coming out next week on December 11th, in conjunction with this webinar, will have an extensive appendix where you can look more closely at how we arrive at the market sizing that we discuss here today. I also want to note that it's not advisable to compare the volume and revenue we talk about for each product to arrive at a specific fee percentage, since these are understood as averages across the industry and not fee percentages for specific products within those categories. And I also just want to note that overall, the size of a given product in terms of how much revenue it's drawing in or its growth rate does not indicate a level of innovation or quality overall. Rather, it really indicates the opportunity to look at what consumers are spending and how best to address their needs and address their interest in those products with valuable and quality innovations today and in the future. The key facts of the underserved market in 2013 are as follows. In 2013, the market generated $103 billion in revenue spent by consumers on fee and interest. And that is based on a volume of consumer usage of $1.3 trillion throughout the year. And this has been sized as growing in annual growth from 2012 to 2013 at just over 7%. And here we can see a nice breakdown of where that revenue comes from in the market among the products that make up that $103 billion in revenue. And we look here at 5 different categories of products that overall make up this market. We break credit into 3 categories. There is single payment credit, which is credit that functions as a very short-term loan and is typically due in one lump sum and typically due in 1 month or less. And this includes payday loans, overdraft, pawn, things like that that are due all at once in a lump sum. Then we also have a set of products that we consider short-term credit. These are usually either installment type structure loans or revolving loans given out as credit cards, either secured credit cards or subprime credit cards. And these are either due on a revolving basis or over time in installment payments that last anywhere from a few months to maybe 2 years tops. And then finally, we have a long-term credit category, which is loans that are typically longer than 2 years in nature, and these include various categories of auto loans and private subprime student loans. And of course, those are due on an installment basis as well over a longer term period. In the payments category, we have a host of payments products ranging from types of reloadable prepaid cards to more traditional storefront model-based products such as walk-in bill pay, remittance, check cashing, money orders. And then finally, we have a category of deposit products and some other things. And that includes checking and savings accounts, traditional accounts. It also includes tax preparation services and retirement plans when they're used to borrow against for shorter-term needs by consumers that often incur fees. So as you can see, this breaks down in a way that shows that there is, among that $103 billion, there is roughly $22 billion in revenue from both the single payment and short-term credit categories, respectively. There is almost $40 billion in revenue annually from the long-term credit category, about 10 from payments, and about 9 from deposits and other. So now let's take a little bit of a look at how those categories have grown from 2009 through 2013 and the projected growth we'll see those products making in 2014. And I should also pause here to note that 2013 is the year for which this report's numbers are focused on because it's the most recent complete year for which we have information. The 2014 year, while almost over now, was about half to two-thirds over at the time the research for this report was done. So we make these projections based on the best available information over the first half of the 2014 year in terms of quarterly reports and other things out there, combined of our understanding of market trajectories to arrive at 2014 estimates for this year that's almost complete now. We can see over the last several years there's been particular growth in the long-term credit category, especially taking off in 2011 and beyond as the effects of the recession started to subside. We can also see that there's been recent significant growth in the short-term credit category as well, somewhat in parallel, not quite as swiftly, while there's been more moderate growth in the payments and deposits categories and somewhat of a flatlining and slight decline, in fact, in single payment credit that's projected to actually dip a little lower than short-term credit next year. And we can also now look more granularly at the individual products that we looked at in the market, that we looked at just a minute ago for their revenue, and now study their growth rates. So this chart shows two bars for each product. The darker bar for each product is the growth in 2013 over 2012 and how much each product grew during the 2013 year. And the paler line beside it is our projections of how much the product is growing this year in 2014 based on its starting place at the end of 2013. And just to note that while some of those growth rates may be lower or higher from 2013 to 2014, they're still actually growing year to year unless they've actually dipped below the zero line there into negative territory. So you can see here we've arranged them from the highest to lowest growth for the 2013 year, and they've maintained the same color scheme as the earlier bars we saw, so you can track what type of product we're looking at. Almost every product seems to have, or every product category seems to have some products that have been showing higher growth or moderate growth this year, although there are virtually no products in the long-term credit category, with the possible exception of buy here, pay here auto loans projections for next year that are actually shrinking in their growth rates. But certainly there's quite a bit of variation among them. So at this point, I want to introduce you to Ariane Schutte, who, as I said, is the managing partner at Core Innovation Capital and our partner in this report. And he is going to describe a little more in detail about the trends we're seeing in the market this year that help tell the story behind the growth and movement in the market.
Thank you, Eva. Can you hear me?
Yes.
Good. I want to make sure I was properly unmuted in all my various ways that I can mute myself. I'm so glad to be part of this, and I want to thank the team at CFSI for doing the lion's share of the work on this. This is really a project that started off the side of my desk a number of years ago as a way to prove out that, in fact, the underbanked weren't just a big policy need, but also represented a big commercial opportunity. And CFSI has really run with this, and Morgan Stanley has been a great partner in the last couple of years to help us advance this work, not just by underwriting it, but by really pushing us to provide a better quality yield. So I want to discuss a number of trends, 5 trends I'm going to cover that we see as a yield from this research. First is the growth in subprime credit products, auto and credit cards most notably. Second is a transition from short-term credit products that is finally overcoming single pay credit products. Third are discussing the yield of some macro drivers in the wake of the economic recovery and how those are impacting various financial products. Fourth is what we perceive as evidence of the maturation of the general purpose prepaid card industry. And fifth is the long anticipated evolution of online channels overcoming storefronts and traditional distribution forms. So first of all, cheap capital is spurring the growth in subprime. We think this is a phenomenon that's a result of low interest rates and a lot of capital seeking high yield, maybe in part driven by the lending club phenomenon, where now a proliferation of asset sources are looking for higher yield in online direct lending models and such, which has really opened up billions of dollars of capital looking for great yield. And that in our sector has evidenced itself in the growth of subprime auto loans, leases, and subprime credit cards. As Eva pointed out earlier, notably an exception that is the absence of growth in buy here, pay here. For those of you who don't know the difference, buy here, pay here is probably the most deep subprime category of auto lending, typically underwritten by the dealership themselves, typically at very high rates, plus 20%, and not backed by capital partners offsite. We think that likely the buy here, pay here lack of growth, contrary to the other forms of growth, are correlated to consumers both preferring a better experience as well as being able to find better deals elsewhere. Subprime auto leases, you'll see, grew the most, 34% in the last year, and we project another 23% for 2014. Subprime auto loans, not quite as much, but still very high in growth rates in 2013. Subprime auto loans represent a $20 billion revenue stream, grew about 20%, 19% in 2013. And we're seeing a lot of really exciting early signs of innovation in this segment. Companies like BP, which raised $60 million recently, Calypso, Shift, are really trying to transition or entirely disrupt the auto purchasing process, moving it from online or from offline to online. We're seeing new underwriting technologies. Companies like Neofinance are providing new alternative forms of data and alternative underwriting into the auto space. On the credit card side, subprime credit card has also seen significant growth, 16% in 2013. We're expecting that to pick up to 18% this year. And excitingly for me, at least, the secured credit card space has also seen some growth, 7% in 2013, and we expect a little bit more in 2014. From my perspective, the secured card growth is exciting because clearly secured cards are a very valuable product to consumers, a great on-ramp to building credit. They have historically not been very popular, and so we're encouraged to see this trend in their growth. All of these things across auto and credit cards, we think, as I mentioned in the beginning, is really driven significantly by greater access for capital that demands high yield, as well as a decrease in interest rates, even though it's fairly nominal. It's like 0.4 this year and 0.4 next year. Nevertheless, we believe that's contributing to spurring consumer demand. Second, short-term credit has finally overtaken single payment credit. And so the way we're thinking of this is short-term credit products are really installment-like or revolving credit products, still with a fairly short time duration. And single pay products are typically 2 to 4 week term periods that have one lump sum payment. So we see on the short-term credit side that grew by just over 11%. We're expecting that to grow 8% in 2014. Single payment credit grew only 1.5% in 2013, and we actually expect that to drop over the course of 2014 by 3.4%. We really think this represents a major shift in the industry, largely driven by regulatory pressure. The single pay products, which consist really of online payday, offline payday, overdraft, and deposit advance, each have seen regulatory pressure that we think is amongst the most significant regulatory pressure of these types of products that the industry has encountered in the last 10, maybe 20 years. Online payday, of course, the Justice Department ran Operation Choke Point, which has significantly negatively impacted online payday, especially for tribal and other lenders. Offline or storefront payday also has been subject to both more strict regulations at a state level, higher uncertainty at the federal level from the CFPB, and so that's been impacted negatively. Overdraft, of course, has been stagnant since 2010, largely due to Dodd-Frank and changes in Reg E. Deposit advance, which is basically the bank's equivalent of a payday loan, have been put out of their misery thanks to FDIC and OCC guidance, and so we really see a dearth of single pay products in the market today, again, largely due to regulatory pressure. Hopefully that will represent opportunity for new and alternative models to emerge, and we expect to see that in the coming years. So both of these are at a point where they're doing about they're yielding about $22 billion in revenue, and where we're seeing today an increase are from products like title and pawn, secured, and subprime credit card. And so a great case in point is you see big companies like Cash America, which have historically been leaders in both online and offline payday, completely transforming themselves. Cash America has moved out its online business, Innova, and has shifted its offline business almost entirely to pawn. Third, the economic recovery, macro drivers have really impacted several exciting products, some very positive, some negative. Refund anticipation checks through the TAC channel went up about 15% in 2013. We expect that growth to go up even further, 16% this year in 2014. For those of you who don't know, refund anticipation checks are basically the fees paid for filing taxes, where the but funded by the expected returns. It's an evolution of the refund anticipation loan, which is decreased almost out of existence. And we think this is up from a macro perspective because there's more tax filings and more tax filers. On the flip side, remittance revenue has gone down in 2013, 3%. We expect it to go down even further during the course of 2014, despite the fact that the amount of dollars has gone up 2% during this year. And so we really think that that is due to competitive pressure and the downward movement of prices. Retirement plan leakage fees have gone down over 5%, and that'll go down further. We think that's a good trend, and government benefit prepaid revenues also down 8%, and will go down further next year. Fourth, general purpose reloadable growth continues, but we really expect to see this to be a maturing market and to see the growth rates decrease. A high amount of usage we're seeing amongst millennials. A lot of it is coming from millennials earning over 50K, and we expect that to some examples of that are innovators like Bank Simple, which was acquired by BBVA last year. No, this year. We're still in 2014. I'm getting my years mixed up. And companies like Movin, who really are addressing millennials through entirely new prepaid like channels that are highly smartphone enabled and provide an attractive alternative to mom and dad's bank. Let's see. Over half of the higher income GPR users began using GPR, general purpose reloadable prepaid cards, in 2013. And almost all millennials, 96% of millennials earning over $100,000 are using a GPR product of one kind or another on a monthly basis. Millennial households that have an income between $50,000 and $100,000 use GPR the most, and we're seeing a 10x per month growth rate there. This really represents a significant departure from the traditional, conventional wisdom that GPR is an adult underbanked only product. We're seeing a growth slowing in the payroll card space from 12% in 2013 to 3% in 2014. This is really due to state and federal scrutiny on payroll cards and GPR cards. That's where we see things going on payroll. Finally, the fifth trend we see, at long last, and this has been highly anticipated by those of us who are more on the tech side of things, we're seeing evidence of moving from the old to the new, from storefront to mobile and other electronic channels. So the general assumption has been that the underserved, that the income divide reflects the digital divide, so that people with lower income are less prolific users of technology, and we see year after year significant evidence to the contrary. And as you see, if you'll advance the slide a little bit, advance. Fill the page. I want to point to there you go. As you see in the lower right-hand corner, if you're following this visually, blow by blow, that the underbanked consumer segment oversamples the population as a whole, both in mobile banking as well as in mobile payments. And we're seeing storefront revenue decrease. We're seeing electronic models increase, right? Both revenue increase of 24%. It's projected to go up more next year, or this year, I guess, in 2014. Prepaid spending transactions are significant versus like ATM deposits ATM withdrawals. And storefront-based transactions are a mere fraction of that, not $1 billion worth. So really things are moving away from the check casher, the traditional brick-and-mortar check casher, the money order, the walk-in remittance, and the walk-in bill pay in favor of more electronically mediated variations. And we see technology innovators like Pay Near Me, Whippet, TIO Networks, and others really represent a moving trend and helping the underserved move from cash basis to electronic basis, and to solve what I refer to as cash in and out problem for populations that have historically been more cash oriented. That concludes my comments on these trends, and now I think we're going to Q&A.
Hi, we're actually going to have a word from our sponsor, Morgan Stanley, and then we're going to have Q&A. So I encourage you all to send in your questions as you're listening to a word from Moses Choi, Vice President of Global Sustainable Development at Morgan Stanley.
Hi, can everybody hear me okay?
Yes.
Okay, great. And thank you so much, Eva and Ariane, for your very insightful comments. Just wanted to do like a 1 or 2 minute just overview and just reiterate sort of our thanks for a lot of this work and for our continued partnership. You were obviously very pleased to partner with CFSI and Core Innovation Capital on this latest installment, and I do appreciate all of those who are on the line who have joined. You know, Morgan Stanley has made a number of strides in really trying to advance sustainable business opportunities, harnessing firms' resources. You know, we've intermediated more than about $875 million in the microcredit sector internationally. We've moved over $7 billion in capital in U.S. community development efforts. All that to say is looking at the financial underserved market and figuring out ways in which we as a firm can support that growth is critically important to our firm. You know, the success of this annual study, I think, is really largely driven by the fact that there really is no other data source that provides this level of detail and a quite expansive view of the market. And so we are quite pleased that, you know, this is the fourth installment and one that we really want to continue to partner with CFSI and Core going forward. We really hope that for those who are on the line, whether you're a policymaker, investor, business person, or perhaps an impact-minded entrepreneur, we hope that this information and data suggests that this market not only exists but is in fact growing, and that there are indeed business models where technology and financial services can reach the financially underserved market. With all that being said, if there are opportunities to you know, answer any questions on what we're doing from the Morgan Stanley perspective, happy to do that as well. But at this point, I'll hand it back over to Eva for moderating sort of the Q&A session. Thank you.
Thank you, Moses. So I think we're going to move now to the Q&A section. Again, if you'd still like to send in a question, please do so in the field on your screen that allows you to type questions or comments. And now I will pose some questions that we've already been getting from some of the listeners for myself, Moses, and Ariane to address. So I think one question that's good to start with is looking at the idea of on and underbanked consumers in this market. The question is around the idea that we've been examining this market at CFSI and other organizations for about 10 years now. So what does it mean that we see that the market is still increasing in spending rather than decreasing? Does this mean that programs are working, aren't working? What is the connection between more consumer spending on alternative products in terms of whether their needs are being met? Ariane, would you like to take a stab at that one?
Yeah, it's a good one. I'm glad that's a question, and I don't have a great answer. Our goal at Core really is to ignite the imagination of entrepreneurs and to provide products and services that will dramatically decrease their revenue costs to the consumer, while at the same time increasing the margin to the provider, really at the hand of advanced technology. And so the fact that the overall trend is going up is a negative indicator from that perspective. I will say that you know, this is both a segment that has more consumers in it year over year, and so I imagine that contributes to its growth. But you know, probably, as the question probably alludes, it's a negative indicator. While it's positive from a perspective that it's large and growing, I think it's negative in terms of you know, the objective to make it more efficient. And something that we'd like to see is really to drive greater efficiencies there, bring it down to $50 billion, but at higher profit margins.
Yeah, I think that's definitely where it's at. And also, I think that something to note is, like I said, this market is really a snapshot of what consumers are spending to address their needs. So within this market, there are both products that maybe indicate that there are needs not being met or stopgap solutions being spent on, but it also indicates products that are part of the solution as well as part of the problem, because they're both in here. If you are a consumer, say, facing a credit need and are underserved in some way, you may be using an installment loan that actually is meeting those needs well through an alternative that's not a traditional bank loan. Or you may be accessing one that indicates that you really are not able to be served in a way that helps you. So there's really a heterogeneity to this market that means its growth, as Ariane said, indicates certainly a concern with the recession that hit during the last decade and other factors that many American consumers are struggling with their financial health and their financial well-being. But the fact that their spending is increasing is a combination of a consideration of whether that's actually a good or a bad sign in terms of products that meet their needs through alternative structures and alternative channels. So another question we're getting here is looking more at the payments field. So when we talked recently about financial technology and storefront versus online channels, what do we think about the idea that people are moving toward those newer technology products? Is it about less availability of bank branches that are closing or not in the right areas for people? Is it about people seeking out products that are not predatory and can serve them better? And what is it about millennials that make them so attracted to GPR cards and using electronic payment systems?
I'm happy to start.
Go for it.
Clearly, everything is moving towards the phone. People are 5 times more likely or 5 times faster in noticing that their phone is missing than their wallet is missing. To me, that's a great meme for what trend is being addressed. Yeah, I mean, my phone has hundreds of apps on it, which give me access to all parts of my life that I used to access through a physical piece of paper and a branch and all sorts of other offline equivalents. That's clearly what's driving millennials' shift in behavior around traditional banks. Add to that the tremendous expense associated with brick and mortar, the tremendous fixed overhead costs, the tremendous inefficiencies with brick and mortar that are really changed not just incrementally but exponentially by technology. So those to me just really represent the crux of the transformation.
Thanks, Ariane. I think a related question that is also worth considering is, given the estimated growth of the use of digital services in the past 2 years, what does this mean for traditional financial institutions? Do we anticipate them shifting more of their efforts to set up their businesses to meet this underserved market and to address the channels through which consumers are increasingly preferring to receive financial services and connect with lenders or payment services?
Well, I'm happy to hear your perspective. Mine is basically that for a variety of reasons, good and bad, a majority of banks aren't killing themselves to serve this customer. Let's say it that way. And in fact, that by and large, the majority of efforts of banks, and there are absolutely exceptions and excellent ones, their primary efforts in serving the underserved is through the CRA part of the institution. We see this not just, to take a broader picture, and not just looking at banks serving the underserved, really we're seeing alternatives to banks being more innovative in providing people a lens into their money or tools with which to manipulate their money that are tying into banks. And one technology trend that we're really excited about is the trend of technology companies that are really building APIs or technology tentacles into the banking infrastructure. So old guard companies like Yodlee, which provide access to our bank accounts, are making it possible to do all sorts of things now. And next-gen companies like Plaid.io or BankBox or Knox or Banking Up or Standard Treasury are all creating APIs that make it possible for third parties to build incredible experiences on top of the financial infrastructure of banks. Basically, what we think that will amount to in the future is a shifting role of retail banking, especially pronounced on the underserved side, where banks will continue to be incredibly important, but their significance will be mitigated from a consumer experience perspective, diversified by more technology-centric, more consumer-oriented companies who are leveraging the bank's infrastructure and their regulatory compliance capabilities to provide better products to customers.
Thanks, Ariane. That's really an insightful, I think, set of comments on that factor. And I think something also to keep in mind is a lot of the larger banks, regional banks, have been interested in this space for a while now and are working to serve it better. And I think really what we're seeing more is a hybrid. It's not going to be a sudden movement away from the branches they do have overall, or the structure of having a bank as a place you can walk into. Although there is some, thinking about where those branches are best kept and what hours and what kind of lobby they'd have or physical room. But it's really more of a hybrid. It's really more, as Ariane was saying, of creating a combination and finding the right patterns for consumers of when they'd rather access their accounts, say online, 24/7 on their phone, and for which kinds of services or problems they face, they'd rather come into a bank and see someone face-to-face. And I think a lot of the work really, both for the underserved market and in a more broad sense, is thinking about when consumers want each of those channels for the same accounts even, or for the same products. Because there's the day-to-day usage of all those accounts and products. There's also, one-time events or more complicated transactions or opting in for services that happen. And there's more intricate preferences within those things. So I think one of the areas to explore and challenges in the next few years is to find the right balance of offering a variety of channels for the same products, where banks can really leverage the best of the availability of electronic systems and mobile phone usage, while also being able to maintain more of their physical presence at the same time.
And if I may, Eva, a couple exceptions that I think are noteworthy of banks who are really serving the underserved market in quite creative and significant ways, I'd say include Regions Bank down in the south, which has done a whole product line called their Now product line, focused on liquidity-centric needs of the underserved customer. KeyBank has for a long time now offered check cashing in a lion's share, hundreds of their branches at a significantly lower cost than the check cashers across the street, and has seen some real customer adoption of that. Chase, of course, issued an incredibly progressive prepaid offering as an alternative to a traditional DDA product, and then American Express, through its introduction of its enterprise revenue growth business, introduced several important products that have really moved the whole industry in terms of cost structures on GPR, features functionality sets on GPR products, and they continue to innovate in that sector in incredibly commendable and exciting and innovative ways.
So another question that we're seeing is really around more about our choice of what products we include and what focus we have with the report, which I think is definitely worth addressing. One person asked why we don't look at microinsurance in developing markets like Mexico, or whether we're planning to expand this to other countries. So a little bit about that. In this report annually that we've done, we've always chosen to focus only on the U.S. market. And that's not to say that there's not a lot of interesting opportunity and growth internationally to serve people who may be without bank accounts or other financial services. But the nature of this report is really to zero in on the domestic market, because it's essentially something that is not done anywhere else. There's no other place to look at sort of the full complement of products used by American consumers in a developed economy and their particular set of needs to be underserved in an industrialized and developed United States, as opposed to needs that are sometimes overlapping but sometimes quite different in the third world with microcredit and such. So this is actually specifically focused on the domestic market, and at this time we don't have plans to expand it to the international market. Of course, we'd be very interested if others were to take that task on to look at some similar parallel study of international markets in the way we do here. And another question I'll address at the same time is some have asked about other products we could include here, such as peer-to-peer payments or other web transactions that are up and coming. And I would say, every year we do expand a little bit. Usually products we include as new ones become more available to us in terms of full information. And we encourage you, there'll be a contact point at the end of this presentation to talk with us if you have ideas for products you'd like to see here in the future, or information to help us become even more accurate on the work in progress that is this annual report every year, to achieve greater accuracy and greater inclusion. With the overall note that we're looking for products that essentially are used by consumers who are underserved, as we described earlier, or at least substantially used by those who are underserved. So if a great proportion, or at least a significant proportion of a product does fit into that idea that it's used by people that are seeking alternative services or are struggling with subprime credit or low incomes, it very well could be something we'd be interested in including if there's a significant enough market for it that it's hitting the billions of dollars to show up in a report like this.
I would expect, on that note, we love ideas, and so please send them on, as Eva mentioned. And B, in terms of peer-to-peer lending, I think the primary reason that that's not here is because to date, Lending Club and Prosper, most notably, are really prime products and aren't really offering anything subprime. They used to, but they pulled back due to just terrible default rates. So we do imagine that the next great frontier, frankly, is the next 50% of people who are not perfectly prime and therefore have to utilize more expensive alternatives. And we expect that direct lending and lending marketplaces online will provide a very exciting and significant opportunity to lower costs to consumers and increase margin to capital providers at the same time, using the efficiencies of the internet distribution channel and marketplaces and such. So stand by.
And just wanted to also add, on the question about international, case studies or expanding. Obviously, this is very much a U.S.-focused study, but that is not to say that the conversations that we have with CFSI and CORE do oftentimes trigger thoughts on what's happening in other countries. So again, while this is I would expect it to continue to be U.S. focused, happy to explore other opportunities as well. So agree, please do keep those ideas coming.
Thanks, Moses and Ariane. Moses, I have a question for you posed actually from the Morgan Stanley perspective. Where do you see the investment opportunity in this market size data? What is exciting to you that interests Morgan Stanley that investors should be aware of when looking at this report and the growth in the underserved market?
Yeah, obviously it's a tough question for us. We are very, active in talking to fintech companies and corporates that are more mainstream, that are looking at the underbanked space and dialoguing on where there might be opportunities for us to engage. Obviously, I know some of the earlier comments dealt primarily with it from a consumer banking perspective. For those that are on the line, Morgan Stanley is a traditional investment bank, and so we are really just sort of the financial intermediaries providing advice or financing. All that being said, I think where there are some opportunities that are opening up tend to be kind of in the lending space, to the extent and where that actually supports or meets the needs of the financially underserved. It's just one of those questions that we on our team think a lot about. But there are obviously alternative lenders in this space where we think that there will be some really interesting, I think transactions we hope and anticipate in the sort of the relatively near future. Obviously payments and the payment sector is another space that we are paying close attention to. But of course, they're getting the right scale for a company and getting those companies to scale up for us to have a role, obviously is can be a bit challenging. But at the same time, we do think that what's happening with the sort of the disruption in the consumer banking space, we do anticipate over time there will be some opportunities there.
Thank you, Moses. I think we have time for about one more question. So we've definitely been getting some questions about, given that this is a snapshot of the market, how do we begin to separate quality products from products that maybe do not help consumers support their financial health? And how do we look at this report in terms of what it means for innovation? And how do we make sure that innovations from other parts of the world, in fact, are drawn in? And those are all, I think, important questions to ask, because this report is really only a starting place for exploring this market as a snapshot of the good, the bad, and the ugly, and everything that consumers are spending. So I would encourage you, first of all, to explore the websites of CFSI, Core, and Morgan Stanley's Global Sustainable Finance Division to answer more of these questions, because this is really only one report of many that we do and one of many activities we do in terms of looking at innovations from across the globe and from innovative startups in this country as well. And it's only one report of many that get much deeper into the question of how you identify quality, how you support quality in the market, and what kinds of best practices can drive that quality, which is primarily a project of CFSI's Compass Principles guide. So I encourage anyone who's interested in those questions to contact us and to explore our website further, because this is really a report that takes this snapshot as a beginning point for a conversation, but it is in no way the end of that conversation. And before we end, I also want to, first of all, thank everyone for attending. Thank Moses Choi and Ariane Shuta and everyone involved in the creation of this report and holding this webinar today for giving us some really wonderful insights into how this market is functioning and hopefully sparking more conversation from those listening today and from those that will be reading the report coming out. So the report itself will be released next Thursday, December 11th. It can be downloaded from CFSI's website. You can also subscribe to CFSI's research alerts for future reports and publications that will be coming out at the web address there below, cfsi.com/subscribe. And I also want to note that the slide deck we saw today during this presentation will be sent to all participants after the presentation. And I know many of you asked questions that we did not have a chance to get to today. So first of all, thank you for all the wonderful questions. We had several dozen posed and only time for a good handful. So just to let you know, we will definitely get back to you. We can see who asked what question, and we will be happy to contact you with answers to questions that we didn't have time to address on the line today. Any final words, Ariane or Moses, that you'd like to give before we sign off?
Yeah, I would just say, we're really thankful for all those who've joined, and I look forward to continuing this dialogue. Thank you.
Well, thank you both.
Thank you
both, and we encourage you to keep talking to all of us and exploring this market, which is significant for so many Americans and for so many companies in this space.